Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Muddle through scenario, stimulator of last resort. This is, as I said, the U.S. is trying to stimulate the global economy through more and more debt, and basically, and again, we're not quite sure if this is the case, but it sure looks like they're trying to use the dollar to juice the global asset markets again, as they did in the last cycle. Whether or not that is successful, if it is, it does suggest that the dollar can continue to go lower. This whole green shoots continue to push higher based on global liquidity out there, U.S. dollar-based liquidity back in the market. If you look at global interest rates, you see the U.S. dollar, the 3-month yield, very, very low relative to the major currencies out there. That sets up the scenario of the dollar carry trade, and one of the reasons maybe, well, there's a lot of reasons, but it's the impact, or at least the effect of one of the reasons of the U.S. Fed pushing interest rates down close to zero, 0.5 or wherever we are here on the Fed funds, 0.25. The dollar looks like the carry trade currency. People are going to borrow dollars at 0.25 or whatever they can get them at, not necessarily that low, and then reinvest that money back into other high-yielding areas or high-growth areas, capital gains opportunities offshore. The yen has played that role for a long time. The dollar could be playing that role. And the uglier scenario is this debt bomb scenario where the U.S. continues to build government debt and makes the U.S. look like a very, very risky place to be long term, so they can't really escape all the stimulus they're putting into the market. If that's the case, we could see a real drain in FDI, i.e. foreign direct investment coming out of the U.S., and that's a longer-term problem for the U.S. dollar. The U.S. has always been balancing on the, its current account, and there's been very decent foreign direct investment into the U.S. But if the yield is so low and the debt continues high, the idea that the U.S. dollar gets crushed on both bases, a higher risk profile because of debt and very, very low yields, it's a scenario to sell the dollar and keep selling the dollar. And that seems to be part of what's in the market right now. The other scenario, the disaster scenario, the pull the wool over your eyes scenario, is this idea that the U.S. loses its reserve currency status. If you're not familiar with reserve currency status means, let me briefly define it for you. It means the U.S. dollar must be held by other countries. The reason that is because major commodities, oil and wheat and other things that countries have to buy or import, they have to have dollars in order to do that. What does that do for the dollar? It provides a major, major support. Countries have to hold dollars in order to import these commodities, which most countries need. Most countries don't have their own supply of oil. They need dollars to buy oil. So that process in itself says that, the dollar needs to be held. It's the world reserve currency. You don't need to necessarily hold a big supply of yen or Aussie or euro or Swiss or anything else, but you need to hold dollars as a world reserve currency to buy these commodities. So it really is a huge underlying prop for the dollar. Even though the U.S. government has just abused its world reserve currency status in a very, very big way for many years, it provides the U.S. government huge financial and political power in this reserve currency status. And as I said, it's a strong underlying prop. One of the things to watch here is really oil. If countries around the world get concerned about the U.S. dollar and they start to price oil in other currencies, we see Iran, I think, right now prices its oil in euro. If we see that happen, or even switching to a basket type of currency where the dollar is a lower proportion, it would be by virtue of the fact that they're using a basket. It means that many fewer dollars need to be held in the world, and it's very, very negative for the dollar. But one of the concerns is and I think this is one of the reasons in the midst of the global credit crunch we saw the dollar. Another reason we saw it bounce and get some support is if a falling dollar, a really sharp decline, a dollar crisis, means that the U.S. consumer loses a massive amount of global purchasing power, and currently the U.S. consumer is the major buyer in the world. So a decline in the U.S. dollar, a precipitous decline, falling off the cliff dollar scenario, doesn't bode well for anybody because of the fact that the U.S. consumer has to prop up these other countries by what it buys. It takes that much global purchasing power out of the world and would probably lead to a major global depression if we saw this. Needless to say, things from there could shake out very, very differently in terms of the dollar's role. But one of the things you have to keep in mind is that the huge size of the dollar in here, relative penetration across the global economy. It's held in proportion probably close to 70% of all reserves are denominated in dollars. And the dollar volume penetration across the world actually increased during the last bear market cycle. Let me say that again. The volume of dollar, its penetration as a world reserve currency, increased during the dollar bear market. And as the dollar has come out of the bear market a bit, the relative value could push it up to about 70% percentage rate in terms of its held in proportion in central banks around the world. So the dollar has actually increased its reserve currency status, and the reality is there's really no competitor out there for the dollar. The euro is a very flawed currency, and we think it could come unraveled given the problems in Europe. The Chinese currency isn't close to ready. They're a very unsophisticated financial system. Japan really can't play the role either, given their other problems. There's a potential there, and there's a potential basket could replace it, but it could take years. From a one currency standpoint, we don't think the reserve currency status is in trouble. This is a little bit look at the debt, and you've probably seen a lot of these things before in terms of the increase in debt and the concern here, and no doubt it's real. Point I wanted to make here is the fact that we saw again that pop of the excuse me, this aligns with the pop of the NASDAQ right here when the central banks thought we had a deflationary problem, and they generated very low interest rates, which led to massive amounts of derivatives and massive amounts of dollar credit being thrown into the global economy. Interesting that the U.S. government chooses to continue to put debt in the global economy when the problem was too much debt in the global economy. But logic and financial markets and governments usually don't mix. But the concern is that this debt level in the U.S. is rising rapidly. These numbers are probably old and probably look a bit conservative now, given how fast they put money in here. One of the points I wanted to make is, Japan is now approaching 200% debt to GDP, towers over every major industrialized country across the board, and that's the result of trying to use stimulus to get out of the global deflation that started in Japan back in 1990, and it really hasn't helped. So you'd think somebody, some grown-up in the U.S. administration would look at that and say, hey guys, there's a disconnect here, but we haven't seen it yet. And again, that's another reason probably why we've seen so much negative sentiment in the dollar, because of the fact I think a lot of people see it as we do in terms of just total economic mismanagement from our government. So some of the major fallouts of this concern of reserve currency status, as I said, we could see a basket approach for global economies. Something like OPEC going to oil like 50% dollars, 30% euro, 10% yen. If that's the case, the reality is then 50% less U.S. dollars need to be held out there. It'd be quite a hit if we saw that. We're starting to see some individual country agreements. China, Brazil doing a trade deal where Brazil can buy goods based using the Chinese currency instead of the U.S. dollars on the deal. China's trying to replicate this type of scenario with other countries out there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.